now joined by Edan Howell, who is the head of international investment advisory for the Scotiabank Group. Hello, Edan.
Hi there, Joel.
Edan, the big news out there today, or this week, I guess, is that Standard & Poor has downgraded U.S. debt from AAA to AA+. This is the first downgrade in history for the U.S. government. What does it mean that Standard & Poor has made this move? I know the other rating agencies haven't, but what does it mean to the markets out there, both the bond markets and the stock markets, that Standard & Poor has decided to downgrade U.S. debt?
Okay. So it's a very complicated question, and it's a very complicated issue, and I'll try to provide some clarity on this. Essentially what happened is S&P took a look at the United States medium-term fiscal position. Okay, so they said, what is the United States capacity to pay all of its obligations over the next 5 to 10 years? And they said that they are not as strong as they have been in the past, at least in S&P's view. All right, this was something that a lot of people had thought already, but now it's actually been crystallized and sort of made real by a rating agency saying this. So this causes a great deal of uncertainty, and it causes everyone to kind of look around and say, okay, what exactly does this mean? The downgrade itself, I would say, is not terribly significant, and in that it's just an opinion, okay? But it reveals a couple of things. One, it reveals the fact that you've got U.S. fiscal weakness in the medium term, right? This wasn't about the debt ceiling issues. Everyone knows that the United States can sort of pay its obligations today and tomorrow. The debt ceiling issue is just a political thing. But they were saying, medium term, we're a little bit more concerned. And the other thing it does is it highlights the political deadlock that they have in the United States. And it was interesting that S&P's remarks actually touched on this. And said, the United States clearly looks like their political system is not able to handle these kinds of situations as effectively as they have in the past. All right, so it does create a lot of uncertainty. It has created volatility in bond markets and in stock markets. But the downgrade itself is probably less significant than what it actually may say about the U.S. government, and what that then says about perhaps other governments around the world as well. There's going to be a number of things that will probably happen. Since the U.S. government is likely, given the downgrade, they're going to have higher borrowing costs going forward, and that will likely trickle down to other countries and companies and people, all right? And that's because borrowing costs can be determined in a couple of ways. Interest rates can either be set from the top down by the Fed or by other government agencies saying, here's what the short-term interest rate is going to be. But borrowing costs are also set by the bond market, and we could look at that as sort of a bottom-up approach. So we know that the Fed is saying that they're going to keep interest rates down, but the bond market looks like it's going to be telling people that there's more risk out there, which means it's going to cost more to borrow money, and that could dampen global economic growth.
I see that fear, and I know that's what everybody said. The downgrade is going to increase borrowing costs, but I guess the irony is in the very short term, the volatility appears to have driven people back to U.S. Treasury bonds, and actually, the 10-year note and the 30-year note in the very short term, interest rates were lower on the very instrument that was downgraded. So does that mean Standard & Poor made a mistake, or is that just a quirk of the markets reacting in the very short term?
It's a very interesting point, and it's interesting to have watched how this has played out. Again, what it is called a flight to quality. So whenever you have uncertainty in bond and stock markets, investors take their money out of the stocks and bonds that they were in, and they put them in the highest quality securities that they can find in an effort to find a safe haven, if you will. U.S. T-bills have always been that safe haven, right? They've always been AAA rated, which is to say the very highest rating. They've always been the most liquid security out there, and they are in U.S. dollars, which is the reserve currency. So the fact that flight to quality went to U.S. T-bills tells us that this rating downgrade is not the equivalent of a disaster, right? It's not the equivalent of someone having just pushed the U.S. economy over a cliff or anything like that. Going from AAA to AA plus is not, it's not drastic. Companies and governments are still going to use U.S. dollar T-bills as their store for liquid cash. Over the medium and long term, there may be a balancing out of that. Certainly, large U.S. T-bill holders like the government of China are talking about diversifying their currency risk and perhaps holding some liquidity in other securities. But the flight to quality tells you that, again, the United States T-bills, they still are the place to put cash, and there still is a high level of confidence that those particular obligations will be paid by the U.S. government.
And of course, Canadian listeners may be aware that for many years Canada was a AA plus, not a AAA lending risk. But Edan, on a broader scope, putting this piece, the downgrade, in the larger puzzle, what does this mean for the global economy? We know that globally we're in the midst of a very, very soft recovery from the recession of 2008. We're still in that soft recovery. What does this mean, in your view, for the global economy?
Okay, I think it means a couple of things. The first is that it's going to cause countries, governments, and people around the world to reassess their debt levels. All right. If S&P is saying that the United States basically has too much debt and is not earning enough, or has some concerns about how it's going to pay that debt, this isn't just the United States, right? This started in, we had Greece, we had Portugal, we had Ireland, we had Italy, Spain. Now we're hearing about France. We're even hearing a little bit about the UK. Everybody is going to have to reassess their debt levels. Probably globally, governments, and companies have been extending themselves a little bit more than perhaps they should going forward. That also means that the companies and governments are going to have to reassess their fiscal plans, which means, how much money are they going to need to fund their operations in the short, medium, and long term. And likely, if they're reassessing their fiscal plans and their debt levels, then they're probably going to do what's called deleveraging, which means basically paying off debt. If you are paying off debt, you are making very tough decisions, and we've seen in the United States that tough decisions can lead to a great deal of political uncertainty and perhaps a great deal of political animosity. We're going to see that. We may see people when tough decisions are made by governments, you see people in the streets, and we're seeing that around the world. And it also means if people are taking money and paying off debt, then there's going to be less investment. That's probably going to be a bit of a brake on growth. So if everyone is realizing that they've got a little bit too much debt, that is bound to slow the global economy to a certain degree over time.
I just want to touch on something you said, because I think there are a lot of tough decisions obviously out there, but the one decision that the U.S. seems to have taken off the table is the revenue side of this equation. And is there really any way out of the situation the U.S. finds itself in without at least looking at the revenue side of this question?
No, I mean, the political situation in the United States is bordering on the ludicrous at this point. And there was a deal that could have been made, right? They could have sorted this out, but there's a lot of brinksmanship that's going on. They're going to need to manage their expenses, and they're going to need to manage their revenue, and those are two sides of the same coin. If they can they're going to have to find ways to cut their costs, especially in terms of large entitlement programs. But they're also going to need to find a way to raise their revenue, which means tax reform. And both of those things are going to have to happen. They're going to have to find the political will to resolve that. And it's not that it's an easy compromise to try to achieve, but it's not difficult to look at the big picture and say, they're going to have to do something with tax reform.
Edan, now the question that I think most of the listeners here on CKLN are going to be worried about is the Canadian economy. Mm-hmm. We came through 2008 better than most countries globally, I think, because our banking regulation had put us in a better stead. Our banks weren't as badly hit as some of the others. But nonetheless, we're heavily tied to the U.S. And if the U.S. is going to have trouble paying its debt, if the U.S. seems to be trapped in this political gridlock, What is the impact on Canada? Can we skate past this, or should we be bracing for some pretty rough water ahead as well?
I think Canada needs to be prepared for an uncertain global context that our economy participates in. All right, so yes, we are going to be impacted by what's going on in the global economy. That, if you step back and look at it, that's a good thing, right? In that you want Canada to be integrated into the world economy. You don't want it to be some sort of hermit economy. So that's not necessarily a bad thing. It's important to distinguish between government finances versus corporate balance sheets. So much of the Canadian economy is driven by exports, and for the most part, we're exporting to companies, right? It's more important for stock and bond markets, and when I talk about bond markets, for the moment, we'll exclude the sovereign bonds, right? We'll talk about corporate bonds here. It's more important what's going on with the particular company that you have invested in or the company that you have borrowed from, right? So I don't think that the Canadian economy is any different now than it was before the downgrade. It's just that if the United States is going to struggle and we export a lot to the United States, we're going to have to manage that, and it's probably going to have an impact on us. And how we go about dealing with this and the kinds of decisions that we make going forward are going to be very, very important.
Edan, I want to thank you for joining us and trying to make sense of some of this incredible volatility that we've seen out there. As I said, Edan is the head of International Investment Advisory for the Scotiabank Group. Thank you so much for being with us this morning, Edan, and trying to make some sense of this.
Yes, sir. You're very welcome.
Have a great afternoon.
You too, Joel.